Imagine walking into your favorite restaurant, a place you have gone to for decades. The Red Lobster. It is an American icon. For years, it was the place where middle-class families went to celebrate birthdays, anniversaries, and graduations. It was famous for its endless shrimp and its Cheddar Bay biscuits. It seemed invincible. And then, in May of 2024, it suddenly filed for Chapter 11 bankruptcy. The headlines were immediate. They were funny. They mocked the company. They said, "Americans ate too much shrimp." They said the $20 all-you-can-eat deal was a business blunder that ate the company's profits. It was a simple story. Gluttony killed the business. But that story is a lie. The shrimp did not kill Red Lobster. You did not eat too much. The company was profitable. The customers were loyal. The lines were out the door. Red Lobster was murdered. It was murdered by a financial weapon designed on Wall Street. A weapon that extracts cash from healthy companies, loads them with insurmountable debt, sells off their assets, and leaves them to die. This weapon is called the leveraged buyout. And the people holding the weapon? They are not restaurant managers. They are not chefs. They are a group of financiers who operate in the shadows. They are called private equity. And they are not just interested in shrimp. Look around your town. Look at the veterinary clinic where you take your dog. Look at the emergency room at your local hospital. Look at the nursing home where your grandmother lives. Look at the single-family home next door that just got turned into a rental. Look at the car wash. Look at the HVAC repair company. They are all being bought. They are all being loaded with debt. And they are all raising their prices. You are wondering why the cost of living in America has become suffocating. You think it is just inflation. You think it is just the Federal Reserve printing money. But there is another hand in your pocket. In this deep dive documentary, we are going to expose the shadow rulers of the American economy. We are going to explain, step by step, how private equity firms like Blackstone, KKR, and Carlyle have effectively bought the United States. We will deconstruct the mathematical trick they use to get rich while bankrupting the companies they touch. We will show you how your own pension fund is unknowingly financing this destruction. And we will reveal the terrifying new bubble. They have created a $1.5 trillion shadow debt bomb that makes 2008 look like a rehearsal. This is the story of the silent takeover. Welcome to Finance Prism. To understand how an entire economy gets hollowed out, you first have to understand the tool they use. It is called the L.B.O, or leveraged buyout. It sounds complicated, but it is actually shockingly simple, and once you understand it, you will see it everywhere. Imagine you want to buy a house that costs $1 million, but you do not have $1 million. You only have $100,000. So, you go to the bank and borrow the other $900,000? This is a mortgage. It is normal. If you don't pay the mortgage, the bank takes the house. The debt is on you. Now, imagine a different scenario. Imagine you want to buy a company. Let's call it Tony's Pizza. It is a great business. It makes $1 million a year in profit. It owns its own building. It has zero debt. The price to buy the company is $10 million. If you are a private equity firm, you do not use your own money to buy it. You put down maybe $1 or $2 million. Then, you borrow the remaining $8 million. But here's the magic trick. Here is the crime that is legal. You do not put that debt on your own credit card. You do not put it on your firm's balance sheet. You put the debt on the pizza company. Suddenly, Tony's Pizza, which was healthy and debt-free yesterday, wakes up today owing $8 million to a bank. The company now has to use its own profits, the profits that used to go to paying workers or improving the pizza to pay the interest on the loan that times used to buy it. You effectively bought the house using the house's own credit card. But it gets worse. The private equity firm is not done. They want their down payment back. So they force Tony's Pizza to take out times another times loan. Let's say $2 million. They take that cash and pay it to themselves as a special dividend. This is called a dividend recapitalization. So now, the private equity firm has all their money back. They have zero risk. But Tony's Pizza is now drowning in $10 million of debt. To survive, the pizza shop has to fire half the staff. They have to switch from real cheese to fake cheese. They have to raise prices by 30%. The product gets worse. The workers suffer. The customers pay more. And eventually, the debt becomes too much. The pizza shop goes bankrupt. The private equity firm, they walk away. They already made their money back, plus a profit. They are fine. The bank takes the building. The workers lose their jobs. This is exactly what happened to Red Lobster. A private equity firm called Golden Gate Capital bought Red Lobster in 2014. To make a quick profit, they looked at Red Lobster's assets. Red Lobster owned the land under its restaurants. That land was valuable real estate. So, the private equity firm sold the land for $1.5 billion to get cash immediately. Then, they forced Red Lobster to times leaseback times the restaurants they used to own. Suddenly, Red Lobster went from owning its buildings to having to pay massive rents just to exist. When inflation hit and costs went up, they couldn't afford the rent. The endless shrimp didn't kill them. The rent, which was created by financial engineering, killed them. This model, the leveraged buyout, is the engine of modern capitalism. It prioritizes short-term cash extraction over long-term survival. And for the last 40 years, this model has been applied to toys, to shoes, to supermarkets. But now, they have run out of retailers to buy. So they are coming for something much more important. They are coming for your life support systems. Have you noticed that going to the veterinarian has become insanely expensive? 5 years ago, a checkup for your dog might have been $50 or $60. Today, you walk in, and before you know it, you are hit with a bill for $400, $500, or $600. They recommend blood tests you didn't ask for. They push expensive medications. The vibe has changed. It feels corporate. That is because your friendly local vet is not local anymore. They might still have the name Main Street Veterinary Clinic on the sign. The old doctor might even still be there. But the owner is a massive corporation backed by private equity. This strategy is called a roll-up. Here's how it works. The private equity industry realized that the veterinary industry was fragmented. It was made up of thousands of small businesses owned by individual doctors who care about animals. This is inefficient for Wall Street. You cannot invest $10 billion into thousands of small clinics. So, firms like Blackstone, KKR, and Jab Holding Company started buying them. They sweep through a city and buy 20, 30, 50 clinics at a time. They keep the old names on the door so you don't notice. This is called illusion of choice. You think you can leave one vet and go to another down the street? Chances are, they own that one too. Once they have a monopoly in a zip code, the playbook activates. Step 1, raise prices. Step 2, cut costs. Reduce the number of vet techs. Make the doctors see more pets per hour. Step 3, upsell. They install software that prompts the staff to push unnecessary tests and products. There was a report from Bloomberg recently about a private equity-owned chain called National Veterinary Associates. They manage over 1,400 locations. Veterinarians who worked there reported being pressured to generate revenue rather than focus on care. The burnout rate for vets is at an all-time high. Suicide rates in the profession are alarming. And pet owners are being forced to choose between their bank accounts and their best friends. But it is not just pets. It is humans too. Private equity has moved aggressively into emergency rooms. Companies like Team Health and Envision Healthcare, owned by private equity, bought up the staffing contracts for hospitals across America. They were the ones behind the surprise billing crisis. You would go to a hospital that was in your insurance network, but the doctor who saw you worked for a private equity firm that was times out times of network. Weeks later, you would get a bill for $3,000. They did this on purpose. It was a revenue strategy. They are buying nursing homes. Studies show that when a nursing home is bought by private equity, patient mortality rates go up by 10%. 10% more grandmothers and grandfathers die so that the fund can hit its internal rate of return. Prescription drugs, fewer staff, more sedation. It is an extraction of value from the most vulnerable people in society. They are buying dental chains. They are buying dermatology clinics. They are buying hospice care. They are buying the infrastructure of birth, life, and death. And in every single case, the pattern is the same. Prices go up, quality goes down, the debt goes up, and the profits flow to Wall Street. Now, let's look at the asset that matters most to your financial survival, your home. We have talked in previous videos about the housing shortage. We talked about interest rates. But we have to talk about the institutional landlord. After the 2008 crash, millions of Americans lost their homes to foreclosure. Banks were sitting on thousands of houses they didn't want. The federal government, desperate to stabilize the market, invited private equity in. They said, please buy these houses. And they did. Blackstone created a company called Invitation Homes. They bought tens of thousands of single-family starter homes, the kind of homes that young families used to buy to build wealth. They turned them into rentals. Today, institutional investors own roughly 40% of the single-family rental homes in the United States. In some neighborhoods in Atlanta, Phoenix, and Charlotte, they bought 50% of the houses for sale in a single year. They come in with all cash offers. They outbid regular families. They close in 3 days. You cannot compete with them. But ownership is only half the problem. The other half is how they set the price. In the old days, a landlord would look at the newspaper to see what other apartments were renting for. It was a competitive market. Today, they use algorithms. There is a company called RealPage. It makes software called YieldStar. This software collects data from millions of rental units managed by these large corporate landlords. It tells the landlord exactly what price to charge. And usually the algorithm says, raise the rent. But here is the insidious part. The algorithm encourages landlords to keep units empty rather than lower the price. It calculates that it is more profitable to have 90% occupancy at $2,000 a month than 100% occupancy at $1,700. It creates an artificial shortage. It is a cartel enforced by code. The Department of Justice is currently investigating this for price fixing, but the damage is done. Rents across America have exploded, fueling inflation. And remember the L.B.O. model? These companies borrow massive amounts of money to buy these houses. They need the rent to go up to pay the interest on their debt. They are financially addicted to raising your rent. They cannot stop. If rents stay flat, their business model breaks. So they will squeeze you until you have nothing left. This turns the American dream on its head. Instead of owning a home and building equity, you are destined to be a forever renter, paying a subscription fee for shelter to a corporation that views you as a yield-generating asset. You are not a neighbor, you are a revenue stream. Now, here is the plot twist that makes this a tragedy. You are probably asking, where do these private equity firms get the trillions of dollars to buy all these companies and houses? Do they have a vault of gold? No. They get the money from limited partners, or L, P, S. And who are the biggest limited partners in the world? They are pension funds, the California Public Employees Retirement System, CalPERS, the Teacher Retirement System of Texas, the New York State Common Retirement Fund, firefighters, teachers, police officers, civil servants. Here is the sickening irony. A teacher in Ohio puts part of her paycheck into her pension fund every month. She wants a safe retirement. The manager of that pension fund needs high returns, 7 or 8%, to pay for all the future retirees. Bonds pay too little. The stock market is too volatile. So, the pension manager gives that money to a private equity firm like Blackstone. Blackstone takes that teacher's money. They use it to buy the apartment complex where the teacher lives. They raise the rent by 30%. Or they use it to buy the veterinary clinic where she takes her dog. They double the prices. Or they use it to buy the company where her husband works. They fire him to cut costs. The American middle class is literally financing its own destruction. The money is moving in a circle. It leaves your paycheck, goes to Wall Street, is weaponized into a buyout machine, and comes back to destroy your community, raise your cost of living, and eliminate your job. And the pension funds are trapped. They cannot get out. Private equity funds are illiquid. Once you give them the money, it is locked up for 10 years. And the valuations? They are fake. In the stock market, the price changes every second. You know what a share of Apple is worth. In private equity, the firm itself decides what the company is worth. They mark to model, which is a fancy way of saying they guess. They tell the pension funds, don't worry, the value is going up smoothly. No volatility here. It is a lie that keeps everyone happy until the cash runs out. This brings us to the final danger, the one that could crash the entire system. In 2008, the banking system collapsed because banks made bad loans to homeowners. Regulators stepped in. They passed the Dodd-Frank Act. They told banks, you cannot make risky loans anymore. The banks said, okay. They stopped lending to risky businesses. But the demand for debt didn't go away. Risky companies still needed money. Private equity firms still needed debt to do their buyouts. If the banks wouldn't lend to them, who would? Enter private credit. This is the new bubble. Private credit is essentially private equity firms acting as banks. They raise money from investors again, your pension fund, and lend it directly to companies. This market has exploded from almost nothing to over $1.7 trillion today. It is a shadow banking system. It is completely unregulated. There is no FDIC insurance. There is no Federal Reserve oversight. No one knows how bad the loans really are. And because interest rates have skyrocketed from 0 to 5%, the companies that borrowed this money are suffocating. Remember, these are companies that were bought via L.B.O.S. They are already loaded with debt. Now, the interest rate on that debt has doubled or tripled. Defaults are starting to rise, but unlike in the public market, you don't see it. Private credit firms hide the losses. They do payment-in-kind loans, where they let the borrower pay the interest with times more debt asterisk. It is extend and pretend. They are kicking the can down the road, hoping interest rates fall before the bomb explodes. If the private credit bubble bursts, it won't just be a Wall Street problem. It will hit the pension funds, it will hit the insurance companies, and because these firms own the hospitals, the housing, and the supply chains, the disruption to real life will be immediate and catastrophic. It is a systemic risk that is sitting in the dark, waiting for a spark. So, the picture is bleak. We have an industry that extracts wealth, degrades services, inflates prices, and creates systemic risk, all funded by our own savings. It feels like a monster we cannot fight, but you can fight it. Or at least, you can refuse to feed it. How do you protect yourself? First, be conscious of where you spend. When you have a choice, support the local, independently owned business. It is harder to find them, I know, but look for the owner-operator. Ask your vet if they are privately owned. Ask your dentist. Spending money at a local business keeps the wealth in your community. Spending money at a chain sends that wealth to a skyscraper in New York to pay down L.B.O. debt. Second, audit your investments. If you have a pension or a 401k, look at what it owns. Are you invested in high-fee private equity funds? If you manage your own money, avoid the stocks of companies that are loaded with debt. Look for companies with clean balance sheets. In an era of high interest rates, debt is death, cash flow is king. Third, understand the financialization of your life. Recognize that when prices go up, it isn't always supply and demand. It is often financial engineering. Do not accept the narrative that you are just unlucky. You are being targeted. The silent takeover relies on silence. It relies on you not noticing that the name on the invoice has changed. It relies on you accepting that things just cost more now. It relies on complexity to hide the theft. But now you see it. You see the L.B.O. mechanism. You see the sale leaseback. You see the roll-up. Once you see the matrix, you cannot unsee it. You can make better decisions. You can vote with your wallet. You can build a fortress of independence, owning your own home if possible, building your own skills, becoming an owner-operator yourself. The era of financial extraction is reaching its limit. The debt loads are too high. The quality is too low. The consumer is breaking. We may be approaching the end of the private equity golden age, but the collapse will be messy. At Finance Prism, our job is to give you the X-ray glasses to see through the wall of corporate jargon, to show you who really owns the world and how they take your money. If you want to stay ahead of the shadow rulers, you need to stay educated. If this video helped you connect the dots between your vet bill, your rent, and Wall Street, hit that subscribe button. We are going to keep exposing the mechanics of the machine. And I want to hear from you in the comments. Have you seen this in your town? Have you seen a favorite local business get bought out and ruined? Have you noticed the price hikes at the vet or the dentist? Share your story below. Let's build a map of what is really happening on Main Street. I'm the Strategic Director of Finance Prism. Stay skeptical, stay sovereign, and I will see you in the next deep dive.